Well, this is the part that if you ask most of the traders out there, and if you have heard of double bottom, and I would say 90% of the traders would have heard of this pattern. But if you ask how many of them have traded this pattern with a great success, not many of them will tell you that they have actually traded this with great success. And there's a reason why, and there are differences between high probability double bottom and low probability double bottoms. So now this is the topic where we actually compare the differences, how it actually looks like. This is one of the pattern that I do not underestimate, although it's very common to most of the traders. So if you look at the double bottom, most of the traders will say that it needs to have a neckline, and it needs to have a support level at the green line. The green line area is where the price is is where traders anticipate is that's the lowest area of the price. And what they will wait is that they will wait for the price to go slightly or break above the neckline, and that's when they will go long. And of course, there's also another double bottom pattern. With the right hand side, it's a slightly higher than the left hand side of the pattern. So these are the two patterns that I actually do not actually take into consideration as a trade. So once these patterns form, I will just monitor. I will not do anything. And for me to take a down bottom, I need to see a very steep sell-off, almost about 90-degree angle, and then there's some price recovery that attracts people who are going long at this area. And all right, people who are going long at this area, they would actually place their buy entry over here. This part always attracts the traders who are actually anxious on going long, that fears that we'll be missing out the action. So once they place their buy orders over here, they would actually place their stop losses over here. So there'll be a lot of clusters of stop losses over here or even here, these areas. And if I'm a professional trader, what I'll do is that I will flood the market with a lot of sell orders and take out in accumulation phase. I would actually hunt out their stop losses using another flood of sell orders. Right. So all this, I would prefer the price to be developing below the slow moving average at this point of time. And as price recovers to 45-degree angle, and this is also where a lot of traders would also go long, right? Thinking that the price will recover. And also this is where they'll put their stop losses. So now, as it comes to this point, this is where the point where it comes, the biggest shakeout, and there's another 90-degree angle that comes down to take out the stop losses. And as price recovers and closes above the support level, and this is the best time for me to go long, right? So we'll cover this in more details in the next slides. And like I said, I would like most of the part of this structure, more than 50% of the structure, to be developing below the moving average, right? And this pattern, before this pattern, it has to be happening after a long markdown stage, right? So what I'll be trading at, I'll be trading on this, I'll be trading into this bear trap, all right, going long after the price has gone up. Okay, so now after panic selling, Point number one is this is where it attracts a lot of anxious traders who are already waiting to go long. They have placed their orders. Part number two is that most of the stop orders at point one has been taken out, and this is where there's a lot of buy orders from professional traders that has sent the price upwards. So they've bought around these areas, and this is where the retail traders will start to take the price upwards. All right, and of course, when this is happening, the professional traders would stay at the sideline. They'll watch what is happening, what is possible for them to do later on the next part. So they'll wait for the retail traders to take the price upwards, the market, and after that they'll come in and flood the price again. So the third part is where most average traders are accumulating. So, like I said earlier, most of the time I would want to see this structure below the moving averages happening. And the fourth point, this is where a major shakeout comes in. So this is where we want to see the price going very steep, 90-degree downwards, almost about taking out most of the retail traders' stop losses, which are going long. So once retail traders buys at this point, if they buy at this point, they will be placing their stop losses around here. Those who buy around here, they'll be placing their stop losses around here. Right, buy over here. So there'll be lots of clusters of stop losses in between once this is actually happening. And right, finally, if price closes right here, back above the support line at a 0.5, and I'll take profit around this level as a trader. So if I'm investing into a strong fundamental stock, and if this pattern is happening, then I'll hold on to the next significant resistance in the long-term chart. Right. So now this is one of these examples that the price has happened recently. And this is in Nasdaq that happened on the 29th of June this year. And the price has a very steep sell-off. And what has happened is that, okay, once professional traders, when they buy in a lot of volume, it will form some kind of reversal candle right here. So now we take this as a support level, and after professional traders has accumulated in a very low price level, then the seasoned traders would rush in and buy around this area, or anxious buyers, they would come and buy. So we call them the first wave buyers to take on early signs of reversal. Then this is where they anticipate the price would continue to go up after buying from these levels, right? So that's the buy order levels, clusters buy orders, and clusters of stop losses. So then as price develops, there'll be more traders coming in if they see if they see bounces in the price. So this attracts the second wave of buyers who are retracement buyers that will take on any late signs of reversal. So they place their buy orders over there and stop losses over there. So as price keeps developing and it looks like it has break some kind of resistance, it's turning into support, then this is where breakout buyers will come and take this pattern. They'll chase this candle, this long bullish candle, anticipating that the price will go a lot higher. So that's where they'll place their stop losses, their buy orders, and this is where they'll place their stop losses. So once everyone sees that a lot of recovery has been happening in this price, and this is where the professional traders would flood the market with a lot of sell orders. And this will actually take out, as they accumulate, this is where they collect the stop losses of the retail traders. Right, then after that, there's small signs of reversal, and there'll be fourth wave of buyers here. There'll be also anxious to buy when there's any sign of reversal over here, placing their buy orders here and stop losses. But the thing is that there's no clear candles like bullish pin bar or bullish markup bar to actually take an entry for me right here. So what we want to wait for, we want to wait for the price to go a lot lower to take out the remaining stop losses right here. And then also the ones who are anxious, right? Before closing back inside the support significant support level. As price recovers even more, then I would take it when it starts to retrace. So this is where I'll put in my buy order as the price retraces. So the support is holding on strong. This candle right here with a long wick means that there's a lot of seasoned traders right here who place their buy limit order right here. So that's a good sign of a rejection from going lower. Right, but the only thing is that sometimes if you wait down here, you might actually miss the trade because sometimes price, um, after it has formed a very good buy signal in this candle, and after that, in a very liquid moment, price may continue to go up without you. Because most of the time, what I'll do is that I'll just place a buy limit right here. But the thing is that this be okay. You have to be okay if you miss the price movement when it goes up. Because the reason that I do not want to chase the price, if I place my buy order right here, what will happen is that I need to place my stop loss around this area. So if I do this, then my risk return reward ratio would be very bad. So if imagine if this is 1R, then if I size that 1R, my 2R would be higher than this part. Usually I would like to take my profit before the price reaches here to the next significant resistance, because anything could happen over there. All right, the price could reverse over there. So what I would prefer is that I would prefer to put my stop losses, my buy order over here, buy limit, or sometimes I even put a lot lower, so that I can have a tighter stop loss between my buy entry and my stop loss and my buy entry, so that I could actually have my 2R around this area, ideally, then anytime not higher than this area. All right. So, okay, as the price develops, so you notice that the price did not actually go up very fast. The market did not take this up with very high. It's not with very strong bull rally. So it actually starts to stall around this area. So what is happening over here? So let's go into a bit more detail on that part. So this is the area that we talked about just now. And what we notice is that this part, there's still more accumulation signs can be seen. Because to most traders, they'll say, okay, this is just a consolidation, it's nothing much. But to me, this means a lot. And if I actually magnify this part, and this is what has happened. There's a golden cross over here, and the price when there's a double bottom, and after double bottom, when you see a golden cross, which means the price is in positive flow at this moment. So let's move on. All right, so that's where we can see the golden cross. So right after the golden cross, we can see there's some signs of bullishness. Once the price tests the long-term moving average, then we see some bounce over there, and this attracts a lot of retail traders to come into the play. And of course, this is the part where professional traders just allow the market to take it up right here. So they'll wait on the sidelines to see what happens, because once they know that if traders are taking up buying over here, they will have the stop losses somewhere around here at this area. So what they'll do is that once they see that, then they'll start to initiate the accumulation phase. Then they'll start to shake them out with a huge red candle, flush them out, and after that, Once they flush it out, they have got some buy orders. It creates some bounce over there and more shakeouts. So now you see more recovery, and this is giving a lot of optimism. This green candle right here will give a lot of optimism signal out to the market. So a lot of people will start to, oh, now it looks like the price is going to go up later part. So this is where they place their buy orders also as well. So when the candles that huge, then they do not have much room to place their stop losses below here, right? It will give them a very bad risk return ratio. So right there, then price starts to come down because professional traders, they are keeping the price, they are keeping them in the trade without taking their without the retail traders taking their profit. So they're keeping the price down at this moment. So another candle that actually invites a lot of euphoria at this moment, attracts a lot of euphoria. I mean, a lot of traders go in and then they slam the price down again. So this is just like pump and dump, right? Then another candle just to shake them out, closes back above the moving average. So this is where a lot of stop losses has been taken out. Right. So again, this is a very clear sign to go long for most traders. And after that, they've been taken out again. Right at this candle. More shakeout. So another green candle. Then this is another bullish candle that attracts more retail traders. And if you see small candles moving up, this is normally a price taken up by retail traders. They've placed their buy orders, which slowly waves up. And this is also again where professional traders will stay out from the trade, waiting the sidelines to put their attack action in. So this is where they flush them out again. And finally, this is one of the last candle. They have already probably accumulated enough at this point. And this is where they allow the market to start sending the price upwards. Right here. Right. So, of course, if you see this cluster of candles, they do not have very distinctive structures, but this one has a name right here. This is called tree line strikes. It's meant for accumulation. This is what I call pump and dump, a mini one or micro one. Right, this is just a normal shakeout pattern, right? That we'll see. I mean, which you will see quite frequently during accumulation phases. Right. So, well, what we see is that we have covered this area. So as you can see, the price went up a bit more, then it starts to drift a bit lower after that. And what happens is that there's another double bottom pattern right here, which also induces a lot of fear and invites a lot of short sellers to come in at this part, forming a huge bear trap. So here's a huge bear trap over here, and once price closes above here, and you can see there's a huge green candle right here, the bullish candle, because most of the traders who went short over here, they place their stop losses over here. There's a lot of clusters of stop losses here, and this is where it triggers a lot of stop losses. And as price comes back over here, then it finds support over here and starts to go up. So this is where you see another this is a golden cross, then price starts to go parabolic over here, because the longer the consolidation or the accumulation phase, the higher the price the more parabolic the price they will send it up on the later part, because this is what the price has actually broken a lot of important levels over here. There's a significant resistance level right here. Right. Now let's look into more example. Now this is for crude oil. So it has also formed some kind of a nice pattern. Right. Price has a steep sell down over here, and anxious buyers will come in over here and they place their stop losses, and major shakeout over here. Then professional traders, they buy over here, forming some kind of reversal. Then the market notices that and they start to take the price upwards slowly. As price breaks, it looks like recovery because price is making new highs, higher low, and higher highs. And finally, when the trend is more clear to everyone and there's more people coming in, but they want them, professional traders want them to stay in the trade because they know most of the profit targets are around this area. Right, then that's where they will shake them out with a huge, large sell orders and to pick it up at the bottom later part. So this is where professional traders buy again, and seasoned traders will start to take the price up on the later part. So this is a very nice one. It's just 2 days to reach the profit target around this area. Right. Okay, there's more. This is for platinum. So what we can see, it's also a pattern that has repeated. This is also not long ago. This is in 6th of July. Yeah, 6th of July this year. So what price has done is that price has formed a markdown, then a shakeout, and this is because there's a lot of reversal candles right in this area. Huge pin bar attracts a lot of retail traders. So here, this is where they buy, and then it forms some sort of a breakout pattern. But I mean, professional traders need to keep them in the trade so that they could actually take out their stop losses later over here. So for those who have bought over here, the buy orders, they would place their profit targets over here with the stop losses around these areas. So professional traders will be waiting around these areas to flood the market with a lot of sell orders. Right, as price, so this is where the professional traders will buy again, and of course, we will only trade when price comes back and retests the spot right here. Right, this is a very nice one. Takes around 2 days for the price to reach the profit target. So and as price breaks out the neckline, this important resistance level, and you can see some retracement right here, then the price goes up from there. Right. Okay, this is also what I've traded recently, and this is in British pound futures. This is a very nasty one. In fact, this is the ones that gets most of the seasoned traders to be. This is where people would actually think that the price would reverse upwards over here. And this is where it gets a lot of seasoned traders to be stop out at these levels. Like it's breaking downwards, and this is also where it invites a lot of short sellers, those who are going bearish. And when price closes back inside here, it hits a lot of their stop losses. Those who are going short over here places their stop losses around these areas. So as price closes back in here, and this is where it forms an explosion of price because of a lot of stop losses are over here, generates a huge momentum upwards. And with this kind of green candles, you see a lot of retail traders chasing that. And professional traders would want to get out from around these areas. So right after that, you can see a huge red candle. This is profit taking. Right, then the market notices that this double bottom has already matured, and this is where some other traders will start to take the price upwards. After the golden cross, there will be more traders coming in. Right, so it's a bit nasty on this part, but it's also a very clear sign that this actually traps a lot of bear in the process. So this is where they can actually, professional traders would place their buy limits around these areas to collect the sell orders. Right. So, and it's not just in futures. What you can do is that even in strong fundamental stocks, this happens a lot, very often as well, because in strong fundamental stocks, there are more participants. So, like I said earlier, we need to see some signs of reversal. In this case, after a steep sell-off, we can see a lot of sign of reversals. This is the candle that attracts, in fact, it's a weekly candle. It attracts a lot of retail investors and traders at this part to buy in. Right, those who knows how to read candlestick patterns, they'll buy in over here. We have their stop losses over here. Now, of course, it's not that straightforward in the market. Professional traders are always way more advanced. They know the psychology of the market. They know how to exploit the emotions of most of the traders out there. And of course, they themselves have to be there last time in order to do this. So they have to know both sides' advantages and disadvantages, right? So this is where they take out a lot of sell orders, and of course, this also attracts traders that are more seasoned to buy into this pattern. And again, the market, I mean, the professional traders starts to flood the market with a lot of sell orders to take them out again. So this is the part where you can see there is a lot of accumulation happening here, right? And as even the price starts to recover a little bit, then they start to flood the market down with a lot of sell orders to stop out the seasoned traders. Right, so now as it forms some reversal pattern, more confirmation, and this is where most of the retail traders come and buy. They'll place their stop losses right below those bullish candles. Then as price develops, the market makers, I mean, or the professional traders, they start to actually keep them in the trade. So they flood the market with sell orders again. This is stage accumulation. All right. They keep flushing the market with sell orders to keep them in the trade so that in the later part, they could hunt their stop losses. Right. So as price starts to look like it's breaking out from this consolidation pattern, what we can see is that we can see some sort of pattern right here. And this candle invites a lot of short sellers also right here. And this is where most professional traders will start to accumulate right here as it breaks downward. But then after they have done that, then of course the price starts to surge up more. And this is also where a lot of our public, I mean, retail traders starts to buy into this pattern, entering their stop losses over here, thinking that this pattern has already failed breaking downwards. And here's the final shakeout candle. It's long and aggressive, meant to take out the stop losses over there and induces a lot of fear. So the next candle, the next week when it opens below this support level, and that's where they accumulate the most in their portfolio. All right. So this is the buy signal for me. I would always want to wait for the price to retrace back to this support level around that. So even if you place in investing, I do not have stop loss. So if this is a strong fundamental stock and it's below intrinsic value, if I buy into this pattern, then I wouldn't put any stop loss right here. I would just wait for the price to move above the intrinsic value of 30% higher than the intrinsic value and it forms some flush up patterns, then I'll be ready to close my order. Right. So this is ING. Just now what we saw was BNP Paribas. ING is an insurance company. Again, it has formed a clusters of key reversal candles. So notice that nowadays it's not that straightforward anymore because 10 years ago, when most of the traders, when they start learning, when they see this pattern, after a price has gone up, when they see this pattern, they immediately will start to place some buy orders right here and stop losses over here. So not knowing that there'll be more accumulation process that will be happening on the later part. So it's not that straightforward. Okay, so now this is where public will put their, I mean, or seasoned traders will put in their buy orders. That's where they will place their stop losses. And as price keeps forming again, right here, and most of the traders will see this as a continuation pattern or they call it symmetrical triangle because it looks like it's because it's negative flow below the moving averages, and this is like a downtrend, and this pattern is always known to traders. It's a downtrend continuous pattern. So they'll sell when the price breaks out over here in anticipation that the price would go lower. So, but the thing is that this is the highest the part of liquidity, and it gives the professional traders a lot of opportunity to actually collect large orders over here. You can see that pin bar has already formed once the price breaks out here. There's a lot of a buy limit that's waiting here instead of sell orders. The buy limits are from professional traders. The sell orders are from retail traders, breakout traders. Right. So what happened next is that, right, like I explained earlier. Okay, I explained a bit ahead earlier than my animation right here. So this is what actually happened. So there's a breakout. It was once a red candle, and then a lot of professional traders take a lot of place their buy orders over there. And of course, this is where a lot of traders will think that the price has actually failed in going upwards, downwards, and closes right back into the symmetrical triangle. And this is where it provides a lot of liquidity for the professional traders to take a sell to take on the sell bearish side. So this is where they do a major shakeout, huge long candle, inducing a lot of fear. The minute the candle closes below this significant support level, the next week when the market opens, there'll be a lot of panic. A lot of retail traders, they'll start to sell over there, and actually creates a huge gap downwards, like the price that like it's the end of the world. And what you can see is that you can see that price professional traders has actually placed a lot of buy orders over here at this level, creating a very after they buy into this pattern, they buy into a lot of panic and fear. It creates a huge green candle right here. So of course, this is still not a buy signal yet because the price has not closes back above right here. Because for me to buy, I need to see the price to be closing above this significant support level. Because in fact, a lot of us short sellers will come in and start selling. Like they'll start selling when this happens. This is where not just taking out stop losses. A lot of short sellers will start to come in and they'll sell, 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 sell. And of course, the professional traders will start buying also as well at this area. Right, so sends the price up, but didn't manage to close above. The next week, more short sellers come in and they'll start selling. So the thing is that when they start selling, the professional traders, they have to match the volume to prevent them from actually from the price going lower to for the short sellers to take their profit on the later part. They need to keep them in the trade because the short sellers, when they sell around these areas, what will happen is that they'll place their stop losses around these areas. And imagine if the price comes back upwards here, and this is where they are forced to join into the buying, into the bullish momentum. So as price touches their stop losses, it will trigger the stop losses like a bomb, like a bomb waiting to explode, and it will take the price upwards later part. So, all right. Okay, now this is very noticeable. There's another pin bar that's formed, a lot of buy orders. Then next week, price manages to close above here. And of course, being patient, it's not easy to be patient. And being patient, I will place my buy orders over here, right? At least 50% of this candle, right, with stop loss around this area if you're trading. But if you're investing, then just buy the candle over here at as near as closing. Then after just ride the price upwards, way above the intrinsic value or when it's near intrinsic value, right? You can see that this candle is, if you notice this candle, it's a lot larger. And this is where the short sellers are forced to join into this bull run. Because this is where their stop losses are being actually taken off. So they're like forced to join the bull run here. So that's, all right. So that's the dynamic behind the picture. So same in smaller time frame, but this is what we see in currencies. This is USD yen, and this is very aggressive ones. So why did I say this is aggressive? Is that we can see, yeah, after some sharp sell down, anxious buyers are coming in over here. Then there's another shakeout over here, but this is not too aggressive. But once the price starts to recover, then the preference traders will start to keep that in the trade right here. You can see almost 90-degree shakeout. And there's a final one over here where they collected a lot of stop losses around these areas. Then, of course, again, that when near a candle is a red candle down here, bearish candle. It was once a bearish candle, this long red bearish candle. This is where it invites a lot of short sellers to come in also as well. So this has formed a bear trap, and short sellers would place their stop losses around these areas. So this candle is where it has triggered a lot of momentum, sending the price upwards on the later part. So once the price has broken the double bottom neckline, right? And this is also where they invite a lot of retail traders or breakout traders to come in, and well, again, they have to. Professional traders would want to keep them in a trade without, because if you buy over here, then you need to have your profit targets around this area, because your stop loss will be around this area. So what professional traders do, they will actually start to take an opposite trade here, start to defend these price levels, and flood a lot. I mean, shake them out before continuing going upwards again, and shake them out before continuing going up again. Right. So, okay. That's so. This is where I would like to conclude my video. I hope you have enjoyed this price action trading session, and see you next time.